Good afternoon, ladies and gentlemen, and welcome to the Totally PLC full year results for the 12-month period ending 31st of March 2021 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Wendy Lawrence, CEO from Totally PLC. Good afternoon.
Thank you, Mark. Thank you to everyone that's taken the time to attend this afternoon. You've got myself and Lisa Barter, who's our Chief Financial Officer, and we will run through a presentation with you and obviously try to answer as many questions as we can. So without further ado, if I start off the presentation. So today we're very pleased to present to you our results for the period up until the 31st of March 2021, and this is a presentation that's there to prompt us to tell you the information. So again, if I miss anything, please do ask a question. So as a reminder, and for those of you that are new to Totally, Totally Group is a frontline healthcare delivery business. We have stood shoulder to shoulder with the NHS and other healthcare providers across the UK, delivering care 24 hours a day, 7 days a week. And we make a difference to people's lives by ensuring that they can access the most appropriate healthcare quickly and efficiently. Back when we first started to be impacted by the global pandemic of COVID-19, we withdrew our forecast from the market because I'm sure you can appreciate there were so many unknowns facing the business and the country at that time. It was very difficult to know how the year was going to go. But we surpassed our own internal financial expectations, and our staff have responded 24/7 throughout the period against the fight of COVID-19. We believe that during that period, from the feedback that we've received from NHS England and other organisations across the UK, is that we have responded to every call for help from those organisations, asking us to work with them to provide different solutions to manage the changing demands whilst protecting our own workforce, of course. Everything that we've been done has been done in a resilient, well-planned way to make sure that the standards of care delivery have been maintained to provide that high-quality care service that users of any business for Totally can expect to receive from us. So certainly during the pandemic, whilst it's been very, very busy and we've completely had to change all of our business models to ensure that our staff are safe whilst providing care not only to people who have been diagnosed with COVID-19, but also those that need to access healthcare, that our reputation for being that reliable, resilient and sustainable provider of healthcare solutions has increased as we've gone through the period. We are still busy today, and you'll hear me talk about some more of those examples as we go through the presentation. But for now, I'll hand over to Lisa just to take you through some of our financial highlights.
Thanks, Wendy. Good afternoon, everybody. We think these are an excellent set of results. Our profit and cash generation all continuing to move in the right direction, and this was a particularly pleasing performance during what was, of course, an incredibly challenging year for many people. So revenue up 7.4% to 113.7 million, and that's very much driven by the growth in urgent care, and that division saw 9.2% growth in urgent care. The EBITDA 5 million, so that's up 25%, and really pleased to be able to report a performance that with no exceptional items. It's a nice clean EBITDA. Cash 14.8 million. That was above our expectations. We did see some acceleration of cash towards the end of the year, although there were no prepayments, and retained earnings of 0.3 million. Of course, we have those of you that are familiar with Totally will be aware that we have quite high levels of amortization that's primarily relating to the intangible value of contracts acquired. As I say, cash generation was excellent. We had 7.8 million free cash, and that's as per the items on our cash flow statement, which I'm sure you will have read. I'll just go on our next slide and in a little bit more detail. So revenue, as I said, much driven by the urgent care services. We saw 200% growth in insourcing revenues. So that went from a start-up of 1 million. We then recognised 3 million in this year. And we exited the year at 6 million annualised run rate, and that's continuing on a very solid growth trajectory. Planned care, a reduction of 3 million in revenues, and Wendy will speak shortly about the operational performance of all the divisions. So I'm sure she'll come back to that and be able to answer any questions. We see an increase in our gross margin this year. That was driven again by urgent care. It is the largest part of our group at the moment. And you'll have seen in the annual report last year, if you are familiar with Totally, you may recall a non-recurring benefit that we recognised in FY20. So underlying performance was actually 17.2% last year. So we saw a significant increase in our gross margin and in urgent care. Cash, as I said, we've got no debt, no deferred payments. We are up to date with all of our payments to HMRC, and our cash conversion was exceptional compared to our prior periods. We're very, very pleased with this. If I adjust for the depreciation and amortization, we're still looking at a cash conversion of over 200%. That was driven by the increased profitability of the group. We've had acceleration of debtor receipts. Our customer is, of course, the NHS, and they're very, very good payers. And whilst they didn't pay for any prepayments, there's no prepayment of revenue. There wasn't any forward cash. It's all ours. But they did pay us even earlier than we were expecting. So, in other words, the debt wasn't due. And we've also seen some movement in provisions, all which has helped to our cash balance. On working capital, nothing has changed, and it will continue to be that way. We're not a high capex business, and our monthly working capital cycle is pretty established now. It does swing 3.5 million either way. We had some furlough funds received during the year. A small proportion of our staff were furloughed during the period, and we have no staff on furlough at this point. So we're very pleased to get back to that position. In terms of dividend, we do continue to monitor the level of dividend very closely, and the board, after much discussion, we agreed that it was prudent to hold the dividend at 0.25. There is still a huge level of uncertainty around what might happen again with the pandemic, etc. We agreed, therefore, to review again at the interim results. So we will do that next year. That's it from me. So if I hand back to Wendy, she'll go through each division, and starting with urgent care.
Thanks, Lisa. So moving on to our urgent care division, and for those of you who are already familiar with Totally, you know that the urgent care division is the largest of our three divisions at this time, and it covers about 95% of our revenues. And certainly during the pandemic, this was the division that worked throughout the period with any stops. We were there providing 111 services throughout the period. And again, you remember right at the beginning of the pandemic that the government briefing was very much for anyone requiring to access healthcare services to not present to GP surgery, don't walk into A&E, don't walk into urgent treatment centres, but to access that via 111, either through its telephony service or through 111 online. So you can imagine we've been very busy keeping the service running, and at the same time working in that slightly different way of working with everybody to access the most appropriate service. We responded and mobilised numerous specific COVID-19 services during the year. Some of those continue today. Specifically, we are one of the providers of the healthcare services into the quarantine hotels down at Heathrow Airport. And those contracts were originally supposed to be short-term, but have been running now for quite some time and are now rolling on a 2 to 3 month basis, whilst we still face the uncertainty of what's happening with quarantine requirements of coming into the country. So it's been really busy. As you can imagine as well, during the period when the NHS decided that it needed to stop and pause all of its elective care, all of the back office functions also stopped for NHS England. So we did not see any tenders for new business come out at that time. We did see the publication of the white paper back in February, which was all about the working in partnership, removing bureaucracy, and we were quite upbeat about that and thought that that would work well for us. And indeed, the first tender that was published came from Yorkshire, and the commissioners in Yorkshire, which was the Vale of York Clinical Commissioning Group and the Integrated Care System, put out that tender for the provision of clinical assessment services to the 111 service, of which Yorkshire Ambulance Service are the provider. It was really pleasing that when we went through that process, not only was it completed within a 3-month time period, which is much less than we were seeing pre-pandemic, anything from 10 to 14 months for tender services. This was completed end to end in, I think it was 13 weeks in the end, and more pleasing when that contract was actually awarded to Vocare. And because it's of the new system, it actually offers the opportunity for all commissioners within the integrated care system in Yorkshire to benefit from that drawdown contract. So whilst our initial success was to secure the initial work with Yorkshire Ambulance Service for clinical assessment for the Vale of York, we are already talking to other commissioners within that ICS for what else we can do with them. So a new way of working at this point in time, it seems to be very positive for us, and we are just awaiting further opportunities as the NHS England re-establishes its procurement service. So a lot of the stuff that we've been doing has been geared at COVID-19, but at the same time, we have implemented the new Think 111 First service. And again, that is just formalising what the government asked everybody to do and to use that service alone to access healthcare services. So we're doing way more in terms of clinical assessment service. The new financial model for 111 has been devised to make sure that it recognises that additional work and additional effort. So that's always good when you're working with someone in a partnership way. And obviously, we continue to make sure that we provide PPE for all of our staff, because our business model has completely changed. So in all of our divisions, we now have to ensure that we work in COVID-safe environments, not only for our staff, but also for the patients that we're treating. So in urgent care, it's been really busy. It continues to be busy. At this point in time, we are preparing for a few of the unknowns which we know are coming over the horizon. That includes preparation for winter. We don't know what's going to happen with COVID-19 in the winter. We don't know if we are part and requiring the booster service for vaccination, because if primary care, if they're working on implementing the vaccination boosters, then obviously that will take away their capacity to be able to do their normal work, which will impact on us. And of course, last year, the flu was very much a non-event across England due to the fact that we were in lockdown and people were not mixing with each other, but we are expecting that to be quite different this year. So we're still dealing with a lot of unknowns. We'll react to those and plan for those as we are working in guidance with NHS England. And obviously the next key stage for us is the removal of lockdown from next Monday, and what will that bring in terms of coronavirus and other diseases, because obviously everybody now, as we start to mix again, are becoming unwell. So our urgent treatment centres are very busy, 111 remains busy, so the challenges are still there, but it's a really exciting future for us in terms of what else we can be doing. If we go over to planned care, this is almost the opposite of the coin really in urgent care. So planned care is exactly what it says it is. It's very much an appointment-based service. And when NHS England closed all of its elective care to concentrate and focus all its capacity on the management of coronavirus, GP surgeries, community premises and prisons all had to close for any appointment-based service, and that is where the majority of our planned care service is provided from. So services were halted. Things started to slow down in April 2020, and were closed for much of that period. And in planned care, we started to remobilise from December 2020. And as we're speaking today, all of our services are fully remobilised, and the delayed community dermatology contract in Manchester was mobilised in April 2021. That was originally due to be mobilised in April 2020. So you can see the impacts of that directly. Of course, what planned care are also managing now is the backlog of patients, the patients that were delayed during the period that we were unable to treat them. And so we're in fact managing larger waiting lists and have renegotiated our contracts with our commissioners, not only to reflect the increase in demand, but also to reflect the changes that we've had to make to the care pathway delivery models in order to keep patients and staff safe. So no longer can we have 20 patients sitting in a waiting room waiting to be seen. They have to be streamed very, very differently. We have to do COVID testing, and we have to do deep cleaning regimes between appointments. That is all covered within our costs, and what you should expect to see is a bounce back of the revenue model within planned care, because everything is secured on contract, but obviously if we're not providing service, then we don't get paid. Last but by no means least, if we go on to our third division, which at this point of speaking to you is our smallest division, but only just now, as I'll update you on in a second. Insourcing is all about reducing hospital waiting lists. It's where we take teams of our people, whether they be consultants, senior consultants who already work in the NHS, specialist nurses, operating theatre systems, or general staff to run an operating theatre. We take the staff in at weekends and on bank holidays when those resources would not normally be used, and we operate and deliver services to the patients of that hospital. So the hospital book the patients in, and then on the day the whole service is run by our organisation, which is Totally Healthcare. So it was launched back in October 2019, and between October 2019 and March 2020, we exited the year at £1 million revenue, which was good in itself. At the end of the reporting period that we're talking to you about, given the fact again that elective care was halted, and so the majority of our services had to stop for a period of time, we did exit the period with a run rate, the revenues of 3.1 million. At this point in time, Totally Healthcare are back working in England, Northern Ireland and Scotland, and we have secured a contract with the Republic of Ireland, which was recently announced on an RNS. And our run rate as of the end of June is in excess of £7 million. So you can see that the demand for those services is increasing massively. Last week, NHS England released its latest figures for the amount of people waiting on waiting lists and said that that was now in excess of 5.3 million people. Similar large waiting lists exist in the other areas, but they don't publish them the same as NHS England do. So the pipeline for this business is very, very strong. It works very, very differently to our other divisions in the fact that all of the services for insourcing are secured via framework agreements. And so Totally Healthcare are registered on framework agreements for Northern Ireland, the Republic of Ireland, Scotland and England. And what that means is any hospital that then wishes to use insourcing services just goes to that framework agreement, contacts the provider for a quotation for what they want to do. They talk about the specialty, and if everything goes to plan and it's acceptable, services are mobilised very quickly. Typically, the contract length in insourcing is 2 to 3 months, and then those contracts roll forward whilst the reduction in waiting list is achieved, and it's monitored closely by both sides. So whilst we don't get the long contracts that we would otherwise see in urgent care, there are a hell of a lot of them. So at this point in time, insourcing is very busy. The significance as well about the announcement for the Republic of Ireland, because I have seen some comments on the bulletin boards regarding, why would you announce a contract of 800,000 in terms of the value? One of the significant aspects of that is that the Republic of Ireland haven't typically used insourcing services. So the fact that Totally Healthcare have gone in there as the first provider to do so is significant for us, and we are hopeful that will continue beyond its initial phase of 8 months. So that is a quick canter through the divisions, all very, very different. But if I can just say to you in summary, we believe it's been a great year for Totally. We have responded to the increased demand for services throughout the period, and our staff have responded proactively to everything that they have been asked to do. The business model of working in 3 divisions, I believe, has produced evidence that we have resilience to the way that we're working. We've improved all of the financial indicators, as you can see, and it's, you know, speaking about the resilience and what it's done for our reputation with NHS England, we are now regarded as a high quality provider that can respond when needed to, even when demand is very, very high. And I'm very pleased to say that during the period as well, our one remaining service that was reviewed by the Care Quality Commission was now rated as good. So that gives all our CQC registered services as good. I need to remind you that we do remain acquisitive. And whilst there is nothing that I'm about to announce to you next week, there are many, many opportunities that we are now looking at, which some are just to do more of what we already do, but there are a lot of opportunities for us to diversify our models with the challenges that have presented post-pandemic. And those things include services such as long COVID. We're now told that over 2.5 million people are diagnosed with long COVID, and you know, it's the bit of we can probably support the NHS very, very quickly from our planned care division with the services that are required to manage that. But then there are all the other opportunities around there, and when you look at those people that were impacted the most from COVID, it tended to be those people with underlying conditions such as respiratory diseases or diabetes, or in fact obesity. So there are massive, massive opportunities for us, and the board now are actively engaged in looking at what is the next best acquisition for us to do. We will only be looking at doing earnings enhancing acquisitions. We don't need to buy anything else that needs a lot of work, and we are hopeful that we will be adding to our portfolio throughout the year. And that is one of the reasons why the board decided to keep its dividend at its normal rate. We continued to pay dividend throughout the period, which in itself was quite unusual. We know a lot of businesses stopped, but we didn't. We continued to pay, and we thought it would be prudent just to hold the dividend at that initial level and review it at the times of the interims, because we may need our cash, and we don't have any plans at this time to raise any further funds. You know, it is important to us that we use our cash wisely, and I believe that when we do get to a position of talking to investors about our next stage plans, that you will be very, very pleased. So there is another slide which just confirms our position on how we look forward. I think I've probably covered it all in the presentation so far, so we will continue to look for core market growth. Of course we will, and as opportunities present themselves, we will be looking at those. We always work in partnership. We're always looking at synergies across our divisions. And, you know, there is now, because our footprint is so wide across the UK, there are cross-selling opportunities between our divisions. So we look at every opportunity where we can, where, you know, if we're working in Ireland and we see they're struggling with a particular issue, but we know one of our other divisions can help, then obviously our insourcing team will introduce and cross-refer into our own organisation. So for us, it's very, very busy. We're very, very proud of what we've done, and I would hope that as investors are sitting listening to us today, they share our optimism in what we're doing. The board remains unchanged, and I think, again, the way that we've worked through the pandemic, you can see that all of us, by working together, have got the experience needed. So I can see a lot of questions
That's
pouring in.
Wendy, absolutely. Wendy, Lisa, thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted by investors already, I'd like to remind you that a recording of this presentation, along with the copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Wendy, Lisa, I haven't given you no time at all to review the number of questions that have come through, but perhaps I could hand back to you. Could I ask you to read out the question, perhaps even who it's from, and where appropriate to give a response, and then I'll pick up from you at the end if I may.
Yes, thank you very much. Yeah, we will do that. And if I may, just as a general point before I start answering the questions, I've had a lot of questions raised with me, certainly over the last 24 to 36 hours, about whether the company is aware of some of the more non-factual things that are being published on the bulletin boards. And a lot of what is the questions that are coming through are kind of there. So I just wanted to say to everybody that, yes, I have received your emails and your messages. Thank you. There are a lot of inaccuracies on the postings on the bulletin boards, and we're certainly not aware of any incidents where we will be taken to court about anything or be doing a placing. We do look, we don't read them avidly, but we will be taking advice as to the best way to actually manage that. So just accept my reassurances that I am aware, and the things on there bear absolutely no relation to fact. So if I now go over to some of the questions and just working through them, if I don't think we'll get through all of them, but I'll do my very best here. So the first question from Kane S. With respect to acquisitions, can you talk to how scalable your model is? As we've built Totally and the platform that we've been working on, we have made sure that all of our back office function, our infrastructure, so whether that be IT and tech, whether it be financial services or HR or recruitment, have got some headspace in them. And that became really important to us as the pandemic hit, because obviously we needed to scale things really quickly. So we do still have headroom in those things, and whenever we're looking at an acquisition, we will look about what else do we need to do to make sure that we not only maintain the service that we've currently got, but do we need to invest in those things? So we think our model is very scalable, and yeah, it's not a concern that we have at this time. Jonathan B, brilliant to hear that all CQC registered services are rated good. Are you content with this, or is Totally PLC committed to achieving outstanding ratings? It's a really good question. Within the overall rating, it is actually broken down into 4 domains in every CQC review, and we do have some of those domains that are outstanding. And the majority of the registered services in urgent care, of course, but About Health, which is our big planned care business, they have outstanding ratings within, but overall they're good. There are very few organisations that have overall outstanding. It would be fantastic for us and the staff if they got them, but it isn't an ambition that we've set ourselves. But if we can get some outstanding within those domains, it is particularly pleasing. And we've come so close sometimes, and I think that's as important for the staff as it is for us, to be quite honest. So hopefully I've answered that one. I've got Andy M. Great presentation, thank you. What do you see as the greatest opportunity for Totally moving forward? What's the greatest opportunity? I think I could come at that from many different angles. If you look at it for short-term growth, then that's got to be the insourcing division because of the size of the waiting lists as a result of the pandemic. So with millions of people waiting, obviously the order book for insourcing. So I think we will see big growth in that area. But I think it's also important to note that there are many, many opportunities that now face us, and I think it's our obligation to review what we did through the pandemic and what we did particularly well, and therefore where does it position us for the future. So I think there are as many new opportunities for us, as well as just expanding what we do and growing Totally Healthcare. We didn't, when we launched Totally Healthcare, obviously we didn't know about the pandemic, so we were working on much lower waiting list numbers, and it was already an exciting opportunity. And obviously that's that's grown and grown during the pandemic. Andrew N. Hi, Andrew. I think we've met a few times. A 0.05p increase to 0.03 in the dividend would only cost £100,000. Surely that isn't a risk from a cash point of view, whatever happens with the pandemic, considering your overall cash balance. And no, it isn't, Andrew, but I think the board, if we move to a progressive dividend, I think they want to keep it progressive, and we just don't know what's happening this year. So it was debated. It was probably the longest debate we've had on anything at the board, and there were many, many varying views. But the consensus was at the end of that to continue at the quarter of a penny would be the right thing to do, given that we had continued with dividend payments throughout the year, and we will review it at the interims. So, if it continues as it continues, it will be another lively debate, I would think. But that was the pragmatic view that was arrived at. But it was a big discussion, and of course, every investor I speak to has got a different view on what we should be doing. So you please some and not others. But it is really important to us, and it will be under continual review. Andrew, I also can notice that you've put another question up there. There has been previous comment that Totally could be acquired by private equity. Do you think this is still the case, especially considering the increased profitability? I think it's always a possibility. And, if we are approached, then obviously the board will look into that, take that seriously, and meet its obligations under AIM to let investors know what's happening. But at this point in time, it isn't something that keeps me awake either through excitement or threat. And I think it's just a reality of the kind of company that we are and the opportunities that we face, Andrew. If I move on to Nitin P, please split out your cash increase between 1, quicker NHS payments, 2, longing out payables, and 3, lower provisions, and 4, genuine operational improvement. I'm not even going to ask Lisa to do that now, but if we may, we'll take that offline, and then we can come back and provide you with some more detail on that, because it would take some working through. So we won't put it aside. We will pick it up, but I can't answer that one right now. Do you want to answer the question from Stuart B, Lisa? It says, Lisa, at what point does the company expect currently levels of depreciation and amortization to diminish?
Yes, certainly. So it is diminishing at the moment, but it's still a very material amount, of course. So I'm expecting in FY22 it to be a very similar level, and then it will start to diminish from there. So by the time we get to FY24, it's going to be not material, because of course that's a decent amount of time, having acquired Vocare and having acquired Greenbrook. It's at a sustained level for FY22, because that we still got those original contracts in their current tenure from acquisition. Of course, if we do any more acquisitions and we acquire any more significant contracts, then that's going to change. But obviously, I'm sure you understand that, Stuart. Just briefly, just touching on Nitin's, and there is a bit of detail I need to go back and get, but I would just, in terms of timing effect on our cash balance, there is about 1.2 million timing of additional payments that came in a bit quicker. We do long out our payables a little, but it's the same. It's consistent every period end. So it is most of it is our cash. It is pretty consistent. It's still that value now. It's a little bit higher actually. So I don't know if they want more detail from that. Obviously, as Wendy said, I'm happy to give that later on. But if there's, it's bound to be a general question around whether that is going to reverse, and it's not all but the 1.2.
Thanks, Lisa. So Andrew N, what percentage of the short-term contracts are renewable into the current financial year? That's not as easy to answer as you think, Andrew, because the contracts vary so greatly across the 3 divisions. So, for example, in the insourcing division, all of the contracts are on framework agreements and roll for 2 to 3 months. The longest contract that we've got on there is in fact the Republic of Ireland, which runs through to the 31st of March. But typically they are just rolling contracts because they're off framework agreements. So you will see all of those rolling forward. In terms of short-term contracts, we have very few short-term contracts in planned care, and all of planned care's contracts are actually secure for the next financial year. And in urgent care, the only short-term ones are the ones that are actually dealing with COVID-19. And what they are doing, they're actually rolling forward on 3 monthly intervals. So, for example, we had a call today asking us to enter into conversations about extending the quarantine hotel for a further 3 months down at Heathrow Airport. But none of the big contracts run on short-term contract basis. And as and when they renew or extend, we will put those out onto RNS. But they are only the small, short-term, COVID-specific ones that run just for a period of a couple of months. Stuart B, hi Wendy, what element of variability is there in contracts across the divisions for additional surge demand over and above the contracted level? Again, it's different per division, Stuart, but if I speak about our urgent care division, because I think that's probably where your question's coming from, they typically are block contracts that have a cap and collar arrangement, so that there are some marginal payments that are due for either a percentage under the level or a percentage over. These contracts never go under, in my experience, and you're always talking about an increase. And so typically you'll have the 100% of your contract secure, and then anything that is within a 5% tolerance, we pay at marginal cost. Anything over 5% comes down to a conversation with the NHS. We meet with them quarterly to actually review the performance of the contracts and the demand on those contracts, and we agree at that point the costs over or under that are actually there. So the way that during the pandemic, because I mean, let's be honest, certainly no one working in this business has worked through anything like the pandemic. We received a letter very early on to say that any additional service that we were able to provide would be paid for, that money would not be an issue. And the only thing that we needed to demonstrate is that we were not profiteering off the back of the pandemic, and that our costs could be compared back to how our normal costs would be applied to a contract, which was the ethical thing to do, wasn't it? And so, but the reassurance that money wouldn't be an issue, and that's actually come through. The NHS have paid for everything that we've actually delivered during the pandemic and continue to do so. Colin S, will there be any opportunities for the company to help the NHS with their large backlog of less urgent operations? Yes, I believe so. So at this point in time, the way that insourcing is working is they are reducing the backlog of patients on waiting lists as booked by the NHS. So the NHS choose which patients they want us to treat. We're working in a variety of specialties. We're doing a hell of a lot of diagnostic endoscopy work, and that's coming down the long waiting list. So rather than necessarily focusing on those people who have urgent needs, we are being drawn into those waiting lists that are very, very long, and they are typically at the diagnostic end. So they can contact us about anything. If you look on our website, there is a wide variety of specialties that we that we provide. So it is literally up to the hospital what they want us to work on. Nitin, there's another question. However you describe it, you operate a heavily fixed cost business that should have operational leverage. Comps suggest you should be making a 7% to 10% net margin. How fast will this be achieved post-COVID? Lisa, I'll hand over to you because you've been asked this one many, many times.
Yes, thanks, Wendy. It is a good question, Nitin. Thank you. It's post-COVID. It's our aim to get to high single digits, and that's where we're going, and we're going in that direction. As to how fast we'll do it, it's really comes back to the uncertainty and whether we'll be able to get back there as we get into a new normal. It depends what services are going to be required, but we are very much focused on ensuring that bottom line is increasing. I'm very aware of the impact of acquisitions we make on the bottom line as well, and everything that we are looking at, we're making sure that it's earnings enhancing. We are working still with the businesses now. We've got the 3 divisions set up, working very much with them to ensure that their margins are increasing, and they're working hard to increase those returns. So how fast it will be achieved post-COVID, I can't say it will happen in the next 12 months. You're aware we've reinstated forecasts. We have been prudent with those forecasts. We would like to overachieve those forecasts rather than overpromise. So I think watch this space. We're doing everything we can, and we should be moving towards 7% in the next 3 to 5 years.
Thanks, Lisa. And then another question, Kane S. I missed your comments earlier on current annualised run rates. Could you please provide the run rates for the 3 divisions post-period? The only run rate that I mentioned, Kane, was the one in insourcing. And that is where the run rate when we last looked at where we were is just over 7 million for the insourcing division. So I haven't mentioned any of the others, but I think you can assume from what I've said that planned care is back up and running. All services are now running, and urgent care remains busy. So if you look at the forecasts, we're confident in the forecasts that we've put back out to the market. We are still facing a few uncertainties, so we have to be careful about how bullish we are, but at the same time, things are going well, and as I say, the opportunities are big, as per my other comments.
I can add to that, Wendy, if I may. There's a number. I do have the number for planned care, and I can confirm that planned care is back at about the same level actually as insourcing. It's in excess of 7 million now annualised run rate, so very much in the return to previous performance.
Wendy, Lisa, I think you've been very generous. I think you've addressed every single question that's come in from investors. So firstly, thank you to those investors that have taken time to submit those questions, and obviously to you, Wendy and Lisa, for responding. I know investor feedback is important, and in light of no further questions, perhaps I could just hand back to you, Wendy, just for a few closing comments, and then, as I say, we'll redirect investors to give you their thoughts and expectations.
Thank you very much. Yeah, I hope everybody's found that really helpful. Again, thank you so much for your time and listening to us and your ongoing support of Totally. I think we're pretty unique in what we do. Well, I know we're unique in what we do. We will continue to seek out those exciting opportunities. We will, as I say, we remain acquisitive, and we will be speaking to you when we know what we want to do. But whilst they are daunting times and uncertain times, we know that our business model works, and we believe that our NHS partners are also have every confidence in what we're doing. It's a shame to see what's happened recently with the share price, but I am hoping that, you know, Lisa and I are making every effort that we can to engage with everybody, that we can return that to the levels we think it would be. So thank you very much, and I do hope that we've provided you with information that you very much needed. Thank you.
Wendy, Lisa, thank you once again for updating investors. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Totally PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.